Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Hello and welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks. Vance, how are you today?
Today is a great day. It's a great day to be talking about private banking.
Absolutely. Well, today we're going to get into a topic that confronts every private banking family, and we like to call SMART risk framework. How do families make wise decisions with the deployment of their banking capital? That's what we're going to address. We're going to address some do's and some don'ts, how to succeed and what not to do if you want to succeed.
Yeah, I think, to get this started off, the word that comes to mind every time we think about this or talk about this is discipline. This is something that has to be well thought out. It's not a spur of the moment reaction to crisis or a opportunity. If we fall prey to that and we don't adhere to strict procedures, our bank becomes at risk. So tell us a little bit about the structure of that, Seth.
Well, one of the key phrases that has always been a mantra is banks always get the money back. And sometimes people go, banks always get the money. How do banks always get the money back? Well, they create collateralized debt and they lien assets and create cash flow. And when they're lending money, they don't typically make bad loans. And we say in the infinite banking concept world, think like a banker. We tell clients to think like a banker. And so they go, okay, think like a banker. But there's moments where the light bulb comes on. How do you think like a banker?
People don't normally go into that depth about money. We all think we know a lot about money. But in actuality, when you start drilling down to it, the banks are the best at getting the money back. It's art, it's a practice, it's a discipline. And when you think about it, and I ask that question to everyone I talk to, the banks always get the money back. And that's the strategy we're going to help teach and employ for you. So how do you think the banks get the money back? Well, they have to tie it up. In order to get it back, they always have to control the money that they let loose because it's not their money they're letting loose of. It's ours. It's the depositors. So they have to have some contractual agreement that ties that money to the loan. And in addition, in case there's risk of forfeiture of that loan, then there is collateral. So smart risk is what they practice. They're very, very good at it. Even when a loan does default in the banking industry, the banks still get their money. And that's because of the collateral. So everything is well documented, well thought out. The problem with the banking is they don't want to stop on the collateral. You do a $100,000 loan, they want all your collateral. And if you have $1 million worth of collateral, they're going to want you to commit the whole thing. And I've always found that amazing. Why not just enough to cover the loan? No, they want what's called control, and they go after it. So how are we going to fit that in to our advantage in private banking? How would we structure that, Seth, so that we can practice this smart risk, but get our money out and get our money to work and then get it back so that we can reuse it?
Yeah, a smart risk framework that's pretty much every homeowner will understand that the bank implements in their home lending is generally an 80-20% loan to value. 80% they will loan, 20% the homeowner has to come up with in a down payment. And that's called loan to value ratio. And I believe that 20% is the cushion in the event that the lender has to take the property back, make it ready for sale, and resell it, or whatever their exit strategy is if they have to take it back. And so that 20% skin in the game, so to speak, of the homeowner is a smart risk framework. So let's take that same concept and apply it to private banking strategies. And you're thinking like a banker, and you're thinking of how do I get the money back in this transaction? And One of the ways is to use appropriate loan to value leverage. Another way is to make sure that your collateral is actually solid collateral and that you don't get off into speculative places and high risk speculative types of ventures and endeavors. And even when you are betting on yourself, sometimes people bet on themselves thinking that they can do something that they can't. And so having rules in place and a guardrail system that says we're not going to deploy any more than X percentage out of our banking capital at any one opportunity. And we're going to require certain types of security and collateralization and to actually maintain a cash flow that comes back to the bank. And that becomes increasingly more important the more generations you have in your family bank and the more layers you have to it and the more people that are in your private family banking system. There have to be guardrails and systems where smart money, a smart risk framework is implemented.
Let me share with our listeners a little bit of history with Nelson Nash and the 60-40 rule. The 60-40 rule comes to play in many different areas that we talk about. Back in the day when I was young and getting my first car loans, banks required 40% down and they would finance 60%. And that was true for a very long period of time. And it's more of a recent factor. I say recent, last 30 years, maybe 35 years, that they've started increasing that to what you modern day now is the 80-20 law. And they'll still bounce back and forth, but banks get very, very tight and they demand a whole lot more because that spread is so thin. The 60-40 rule should be the mark that we try to hit in almost all of our lending assessments. For instance, when we've bought all of our own personal debt, now we have the monthly payments coming into us instead of going out to someone else. Our money is accumulating and we want to put that money to work. So we'll go out to our extended family and we'll talk about maybe purchasing existing car loans that are in their last half of the loan time frame. Thus, we get close or very close to that 60-40 rule, and we can finance, we can take over, we can buy that debt. It doesn't change the commitment or the payment to the person who owes the money on the car, but the family bank normally gets up into the double-digit returns and can make a good profit on putting the money to work that way. But again, we go after those types of loans that have much more skin in the game, and we purchase that debt at a much smaller amount so that the money we have at work is producing a much higher payment or what we call a volume of return.
Right. So the deployment of capital isn't speculative, it's planned, it's structured, it's disciplined. It makes every loan, every investment a deployment of capital. You have to think like a banker and make sure that that's coming back. And those healthy leverage deployment of capital is one of the main cornerstones to keep your long-term wealth.
Let's go back to the car for just a minute. If we wait until the back half on a 5-year loan or 6-year loan, we're at 2.5 or 3 years, there is now good equity in the car. So that equity is there and can be used as collateral. The blessing and benefit in a family bank is that the family bank will work with the borrower, or brother or sister, aunt, uncle, nephews, whatever. If something happens, they can't make the payment on the loan. If it's not their fault, if it was, a loss of job or an accident or something, the family bank can work with that person. They can postpone payments. They can refinance the whole thing to make it a lot lower. They just don't stop it. Where people make a mistake is that, they will forgive the loan or they'll stop the loan. No, we don't do that. We wait for that person to get back on their feet. They finish paying off the loan and it's like they've never left, and there's a lot of equity back in the family bank and that nothing is jeopardized. However, if we have a loan out there and it is the person's fault, the borrower's fault, they get cocky and they lose their job, they go on drugs or they do something really stupid, we're going to have to repossess the car, sell it, make sure the family bank's okay, and they can have the rest. So you can't do that on a new car, because on a brand new car, unless we have a huge bank and we're willing to take that risk, the depreciation It's a minimum of 20%. A lot of times it's 30 or 40% right when you drive it off to try to turn around and resell that thing. So that's what I'm talking about for a bad risk. Sometimes our clients might make a mistake and buy a car, finance a car for one of their children, and it's a brand new vehicle. And now the money is at risk because there is no proper collateral.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Seth, I'm sure you've got other examples of clients out there who have risked their money and it has come back to bite them. The art of banking, though, is not accepting those risks to mitigate every possible reason that a family bank might lose assets at work.
And that's the purpose of smart risk, is to avoid the speculation and prevent emotional decision making. And those are two of the main reasons people will make mistakes. We told you about, hey, these are mistakes to avoid with your private banking deployment of capital. One is avoid speculation, and two is avoid emotional decision making. If you've got structures and disciplines in place, you're going to be able to protect the capital and make sure that it remains strong generation after generation. That safeguards your bank from imploding on itself, from having more capital deployed than the return on the deployment. It's all about return on the investment and securing cash flow for the deployment of your capital. Any business person's mindset or entrepreneur's mindset, that is their intuition, but this turns it into a structure that guarantees your success when you follow the structure.
That's right. There's a lot of balances that you've got to make. And we help teach this, set this up, and literally walk people through getting all this organized and set up. It sounds complicated sometimes because we have to talk about it, but once everything's organized and moving forward, this is very, very pleasant to be able to run successfully. One of the things we have to worry on our checklist is that we have enough liquid assets, remaining assets in there in case another emergency comes up, or juggling of money, because these are living, breathing contracts that provide new capital contributions every year. And we want to make sure we have enough liquidity to take advantage of getting additional capital into these contracts every year. Because after the fifth year, these contracts are so efficient, they go well over 100%. So we want to make sure that that's aligned. And then another one is we have to have a futuristic goal. Where are we in this process? What are we trying to obtain? Are we trying to put enough money to work to accumulate enough assets so that we can start self-financing the next level? I think the ultimate level that we want to get to is financing our own homes, but we can get there by financing all the little things to get up to there.
Let's talk about smart risk filters. What are some of the checklists when a family makes a decision? We've talked about cash flow support, capital protection. Let's drill down on some of those things. What does that mean, cash flow support for the deployment of your capital? And what does capital protection mean? These are things that are critical when you deploy your capital, that is incumbent when you think like a banker. Think like a bank, think like a banker. Well, you have to have a cash flow. If they're going to make a loan on a home, the person that they're making the loan to has to demonstrate that they can pay a mortgage of this amount per month, and the property taxes and the insurance and the utilities, and that it's only a portion of their total income. That's called cash flow support. They're creating a loan that has a reliable, seemingly clear and predictable repayment, the borrower. And if they're wrong, or if they fail, then they've got 20% equity in the home, hopefully, unless it's a depreciating market, and they can take it back and be made whole. So that's a little bit on cash flow support, but let's drill down on those filters, on what the smart risk filters are when you deploy your capital.
We really like to teach this on a family level, and we have a free book that Seth will mention. I put a story in there about financing a bicycle for my grandson, and it teaches about these filters. You've got to have a system set up to where if you lend money out, that payment can come in on a regular basis. The banking that we set up is flexible enough to have payments coming in every week, bi-weekly, bi-monthly, once a month, once a year, whatever the circumstance might be to fit the needs of the person. But the means to be able to repay that loan need to be rock solid. So that filter is, can the person pay this back? If we can't pay it back, where's the collateral so that it can be sold? We can make ourselves whole again. So the cash flow needs to come in on a regular basis because that cash flow is also a commitment for future events. So without that, another event might happen as well. So I think that's important. The asset certainly has to be protected. If we invest in a car or like a bicycle again and it gets stolen, if we don't have adequate insurance or something like that, are things that have to be looked at to make sure that the money is coming back on a regular basis.
I think one of the fundamental principles that in the deployment of capital that has to be a guidepost is don't lose money with speculative and emotional investment. You've got to protect the principal, and that comes through the right loan to value ratios like we talked about. You mentioned 60-40 in prior decades, and now it's pretty standard 80-20. And in the last mortgage crisis bust, they were making like 100% loan because the market was appreciating so much. They made a lot of bad decisions. That wasn't a smart risk framework, lending 100% to borrowers that couldn't pay it back. So opportunities must protect the principal and not gamble it.
Yeah, I remember years ago, actually before I got into private family banking, running a money management firm. A client came in and had a great idea. It was fish farming. And I'm talking about this because this is more than 25, close to 30 years ago. It's when fish marking was introduced here in the United States, especially here in the state of Texas. They had these troughs that were acres long, and they'd have 3 or 4 troughs, and you'd start the fish out at babies, and they would start working down and get to the end, and then they would move from trough to trough, especially fish like tilapia or something. And they would be harvested in a very quick order, but you would have, I don't know what the percentage of loss is from the eggs that come in, but he was talked into doing that and supporting that with his son. And he would come in almost every month and withdraw more money and more money and more money. And we saw wealth disappear over about a year's period of time. And we ended up losing the client. We don't really know, but I think the farming fell flat on its face because they couldn't take it where they thought they could. And there was no collateral. There was nothing else. So the family's wealth just literally disappeared. Bring that to the banking. Seth, you're just so spot on that you cannot be speculative. Banking is not speculative. They don't do that. They may not regulate what you do with the money, but they probably will do that too. But they want assurance that that money's coming back in collateral or some format. And we have to do that too, no matter what, when we're talking about risk, smart risk.
Well, that's a great place to let you guys know about our book that Vance and I prepared with you in mind. It's called Secrets the Banks Don't Want You to Know That Will Help You Get Wealthy. And you can access that book on our website by putting in your name and your email address, and that'll become available to you in a PDF and an audio version. And if you like what we're talking about, you like what we're teaching you in our book, and our podcast resonate with you, you're going to have a very good opportunity, which is to set up an exploratory call with Vance. And the calendar link comes through the emails. So that's the only place you're going to be able to access his calendar. But if you're resonating with our content, our podcast, our book, schedule an exploratory call with Vance. What happens on the exploratory call, Vance?
We're going to just discuss timeline. We're going to set it up, hopefully, and offer you to take it for a test drive, on our dime, so to speak. We're going to ask for your numbers, your monthly expenses, some of your assets. We're kind of loose with the numbers right now coming in so that we can literally show you month by month analysis and show you where you could be if you switch from spending your assets to using them and getting them back. That's what banking is all about. It's amazing. It's all about math. There's no projections. There's no assumptions. And we encourage people to take us up on that because it's fun and it is definitely eye-opening.
Absolutely. So schedule an exploratory call with Vance, and you can take the entire system on an 8-year analysis where step by step it shows you exactly what to do. Folks, we appreciate you joining us, and we hope to have you join us again on our next episode. And until then, any closing remarks, Vance?
No, just hang in there, learn something new about your money, and try to keep most of it instead of spending it.
Awesome. All right. See you on the next one, folks.
Bye-bye.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies Podcast. Click the subscribe button below to be notified when new episodes become available.